Hello everyone, welcome to Finance with JCL. Google was suggested in my Discord server as a potential stock to review and buy, so here's my review. Of Google. I have 5 key categories as to how I review quality companies for my portfolio. The first thing I look at is what's the chance of failure? Chance of failure is moderate to high. I'm not going to buy the company for the quality section of my portfolio. Now with Google, we've got a very low debt to equity ratio. And that debt to equity ratio is under 12%, so it's really low, nothing to worry about there. And that means they've got a low amount of debt in relation to the equity of the company. The interest cover, which is their ability to cover the interest payments on the debt, is also incredibly high. And we're looking at over 200 times, anything over 16 times is what I'm looking for really, so 200 is amazing. And then the current ratio, their ability to pay their day-to-day bills, that's pretty good as well. Long-term average over 10 years of over 4 for that, and certainly over 2 in each of the last 10 years. So generally looking for over 1 at least, so that's really good as well. I think Google's a very relevant company to many people. They're not just for like one single product. They've got a lot of product lines, a lot of things that add value to people's lives. So again, that reduces the chance of failure. And also there's no dividend, which means that they're not necessarily having to maintain or push a dividend higher and having to borrow to do that if they come across difficult times. So for me, the chance of failure of Google is close to zero, albeit it being regulatory factors that might cause them to fail if they ever did, or split them up, but I can't see them failing. So that's a pass for me. Now, the second thing I then look at, most importantly, is this really a quality company? For me, as per Terry Smith, and I'll leave a link at the end. I'll leave a link now above if you want to have a look at Terry Smith's book. Absolutely fantastic. Taught me a lot. And one of the things is that return on capital employed is a key metric in determining the quality of the company. Now, I look for in quality companies a minimum of 20%, and ideally I want it to be 30% for really super good companies. Now, with Google, the long-term average over 10 years is 19%, and the 5-year average is 21%. The trading 12 months is 28%. So they've got a pretty good return on capital. They're good at investing into themselves. And they also have some pricing power. Their gross margin 10-year average is 59%, and I look for an average of 55% or higher. In a perfect world, it'd be 65%. So they're in that zone. And also their operating profit margin, so the profitability of their actual operations, I'm looking for 20% or above. In the perfect world, 30%. And the 10-year average for Google I've got is 26%. The trailing 12 months, 28%. So this is a company that's got profitable operations as well. Now, they're also very good at translating that profit into free cash flow. Their cash conversion rate, long-term average, is 107%. I'm looking at the screen here to get the figures. And even in the trailing 12 months, it did actually dip below to 93%, but it's got a very, very high long-term average. So overall, I'm happy that Google is a quality company. The third area I consider is what I'm calling other factors. Now, the other factors are perhaps not necessarily numerical in some cases, but they are things that can affect the buying decision. For example, Google aren't reliant on 1 or 2 massive customers or contracts, so they've got a non-concentrated customer revenue base, and that's good because it means they're not at behest of 1 or 2 contracts, which if they left or knocked them down a margin, could have impacts on their business. I don't really hold a company like Google in my portfolio at the moment, but do note there is a moderate amount of capex. So one of the things I look at is the cash flow generation, cash flow from operations, and then I look at how that translates to free cash flow, or as Warren Buffett calls the owner's earnings. Free cash flow is a key metric, but to get from cash flow from operations to free cash flow, one has to look at capex, so the amount of that cash is going to capital expenditure. There are some manufacturing companies that need a huge amount of capital expenditure just to keep going, so you actually end up with quite a low free cash flow, even though the operations generate a lot of cash. In Google's case, it's a moderate capex, so it's under 50%. So it's not a red flag, but there is a decent amount of capex that's needed for their activities. The other thing is share buybacks. They're doing some very small share buybacks. The share count has dropped by around about 1% or so in the last couple of periods. So we then get to the valuation. So far, I'm happy that Google ticks the box. Now, this is for me. This is how I look at things for my portfolio. Obviously, this isn't a recommendation to you. Buy, hold, or sell. Please do your own research on that front. But for me, the valuation, I look at a couple of factors, and it depends what type of company. I'm not going to look at book value here, for example, because that's not appropriate. I look at the free cash flow yield. Now, the free cash flow yield for Google, time when I do my calculations, the price in the market was 88. So that free cash flow yield is about 5.5%. And that's the free cash flow compared to the market cap of the company. Now, as a minimum, I want 5%. Ideally, I want 6 or 7%, really. So this 5.5% is above the minimum for consideration for purchase. There's also some growth. Now, growth is a component of valuation because if the company's growing, then today's valuation improves in the future. So the PE, when I did my analysis, was 17. I've taken a growth rate for the next 5 years of 8%. And I've taken that by looking at Yahoo and City Wall Street and look at their analyst projections and try to be relatively conservative with my figure. So the PE now 17, weekly market average, touch above. But in 5 years' time, it could be 12 if they grow as I'm expecting them to be. So the forward PE could be 12 by my calculation. So that sounds relatively good value for someone like Google. Now, Terry Smith has said in his book that the estimated return to the investor could be estimated, as the growth rate plus the free cash flow yield. So in this case, projected return at current price could be 13.5% a year. Now that's very interesting. Above 10%. If you look at my monthly portfolio reviews, I can't get the run rate that I need in order to hit my long-term investing goal. For my stretch target, I need 9.6% a year for the next, till 2050, 27 years or so. So this, if I'm saying it's 13.5% versus what I need of 9.6, I've got a margin of safety there. So either I'm going to overachieve, or if my calculations are a bit wrong, I've got a bit of headroom. So this is to have a margin of safety for a company of this quality at the current price. That's quite interesting to me. Now, I haven't gone through every single factor I consider. This is just a high-level overview of the key ones that I'm pulling out for Google. For some other companies, some of these measures may be different. But at the end of the day, what it comes down to is the buying decision. So I'm going to buy, in fact, I did buy a few days ago a starter position in Google at 88, or 89, I think it was on the day. Based on some of the calculations I got, the free cash flow yield, which I said was 5.5%, it's 6% at around about 80. So I'm going to buy more at 80. And it hits 7% at 69. So I'm going to buy more at 69. So I've got my starter position of around about 1% of my portfolio. I'll add more and then more at those 2 buying points. I'd be happy to have Google at one of my bigger positions, potentially up to 5% of my portfolio. And it does fit my portfolio structure, because if you have a look at my portfolio, I've got that quality stock section, and this fits that based on what we've gone through. And I also have quite a big cash position now, over 20%. So that's sat there earning nothing, and I want to put it to work. So this is a good company to put it to work on. I'm not buying for the sake of it, but it has fit my criteria. So I'd be really interested to hear your thoughts on Google. Do you own Google? And have you been buying more at the current market pricing? And probably another interesting note to finish on. You notice I haven't looked at a price chart at all here. But if we were to look at a price chart, Google's gone down a lot in the last year or so. I wanted to review it without sort of anchoring to, it's gone down by however much it's gone down by, therefore it's good value. I wanted to do my calculations, do my analysis first, and this is where it's come down. To get the most out of this review of Google, check out this video coming on screen now, as it shows my 2023 investing objectives. Check it out, you don't want to miss it.